Well, we want to welcome everybody to the November real estate market update with Catalyst Funding. My name is Derek Engler. I'm the marketing director, and I want to introduce our lending experts here at Catalyst Funding, founder and CEO Wade Comeaux, as well as our director of lending, Jeff Johnson. And we're pleased today to have a special guest with us. Steve Rozenberg I want to introduce Steve. And Steve is a well-known business and real estate coach. Many people know him as an international commercial airline pilot, but beyond that, he has brought such value to helping people create great stories of real estate investing. And he basically is on countless panels, webinars, attends different conferences as a special guest speaker. And today, he's our special guest on the Catalyst Funding webinar. We're glad to have you here today, Steve. And I'll let Wade and Jeff take it from here.
Yeah, I just want to say, one great thing about Steve is that he's not only a well-known speaker, like he has done it himself. He's done deals for, a really long time now. He built and sold one of the best property management companies in the country and just has a lot of real world success. And then he brings that to his people that he works with to help them build similar businesses and succeed in real estate and some of the other businesses around the real estate game. So, Jeff, I don't know if you have anything to add, but we're super excited to have Steve here today.
No, I was checking out your website. It's a slick website, by the way. Is that new? The Steve Rozenberg. I'm not sure where it's
ever evolving.
It's your name right? What's that?
It's that ever evolving. It's like something tumbling down the hill. It just keeps moving.
I like it. Whatever it is, I like it. It's pretty cool. It's got a lot of neat graphics. It's easy to understand. You got some YouTube videos. I was checking it out. It's pretty slick. So whoever built it for you, well done.
Thanks.
I'm pumped to have Steve. He's obviously he does his own speaking, so he can speak to a lot of different facets of real estate. And so, Steve, I would love for you to kind of just tell the people here what you do and what your story is.
Yeah. First of all, guys, thank you so much for having me. I appreciate it. Being a local Houstonian, obviously, having these conversations is always interesting, and I enjoy it. And my background, as you said, is being an airline pilot, local airline pilot. Started with Continental, now United Airlines. Been with them for over 25 years. However, during that time, there was a disruption in the industry for not only for the airlines, but for everyone, and that was 9/11. And 9/11 caused me to realize that safe, secure job that I thought I had, it wasn't safe, and it was never secure, because 2 days after 9/11, I got a furlough notice. And I was told, good luck, you're about to be on the street with 50,000 other pilots, so hope it works. That was, obviously everybody was dealing with 9/11, but dealing with that on top of that really was a gut punch and a snap to reality, which is what got me into real estate. And I realized at that point, I never wanted to have anybody dictate my future. I always wanted to be in control. And whenever you're an employee, you are basically controlled at a certain degree, right? Now, I love flying. I love what I do. I still fly, but I've taken that real estate model of building, scaling, and just keep parlaying it. I flipped, sold, hundreds of houses, some apartments, as well as Wade said, I started one of the fastest growing management companies in Texas. We built it, scaled it, and sold it to a venture capital firm, which I ended up working with as a VP. But now I've kind of, everybody has phases in their life, and this phase now for me in my life, as I get a little older, if I had hair, it'd be gray. But it's a matter of really trying to give back and trying to use the knowledge that I have, which is the last 20 years, to help other investors, other people, other entrepreneurs realize that we're all very similar. We have a lot of the same fears. We have a lot of the same challenges. But they're all survivable, or they could be catastrophic if you don't address them correctly. Just like flying an airplane, very similar. So I have a local perspective when it comes to real estate and when it comes to business, but I also have the international perspective because I coach people all over the world and I travel all over the world as a pilot and as a business coach. I toured speaking in Australia and other places. So I have a different perspective than most people have, not because I'm smarter, but just because I have the ability to travel to Amsterdam, Germany, and these other places where I have clients, and I can talk to them about real estate, and you kind of bring it back into the Houstonian bubble, I guess you could say. So that's the quick version, if there's such a thing. I always tell people I'm like an onion. I just have a lot of layers to me, and you just got to kind of keep peeling back the layers to really understand what I do. That's about as quick as I could make it for you guys.
No, that's pretty cool. I did not realize that you had so many international clients. Not that I want to spend a lot of time on it, but just kind of anecdotally, is there anything that is significantly different here in the States than maybe what you see around the world?
Yeah, it's much more easier here. There's just so many barriers to business and real estate and other challenges. People kind of like laugh. It's almost like they look at, I hate to put it this way, but they almost look at us like spoiled children. They're like, do you have any idea like in Australia, you have tribunals, you have a lot of laws and regulations and a lot of government interference or control that would be unheard of here. And people are like, are you kidding me? I would love to own something in, Houston, Texas. I mean, they're buying stuff in California and other places, which are just sky high, but they're looking at Houston going, I can't believe that more people don't buy. And when we had our management company, 50 to 60% of our clients did not live in Texas or in the United States. The majority of our clients were out of state investors or out of country investors. And we even took it to another level that when we would market, I would look to see where the dollar was higher to the US dollar. So for example, if at that point, the Canadian dollar was stronger than our dollar, which is shocking, but it was. And then we landing pages and websites in Canada to say, hey, why don't you invest in Texas? I did it in China. We did it in all these different places. So we're redirecting the money to Houston. So to answer your question, they're like, I don't understand why people are not buying this. This is amazing. Like, and I'm like, I know. It's like, you don't know what you don't have until you don't have it, kind of,
Sure.
Well, that's a perfect lead-in because a lot of what we're talking about today is national as well as Houston. And so there's going to be a lot of great knowledge that people can take away with a lot of great insights from our panelists here. And so before we get started, I want to offer just a quick disclaimer, and that is that this presentation is just for general information only. And basically, the disclaimer is that no information, documents, estimations presented here, et cetera, if you use them in your real estate investment decision makings, we're not liable. And so we would just want to let you know we're here to be a resource, but we do have to offer this disclaimer. So with all of that, I'll turn it over to our panelists here. I'll be back at the end with questions that anybody that's listening can add. Feel free to put your questions in, and we'll come back for a quick Q&A at the end of this, and take it away.
Excellent. We could go to the next slide, please. All right, and the next slide. Perfect. All right, so I'm going to cover a little bit about Catalyst. I think most of the people on the webinar probably know about us, and we may have jumped ahead one too many slides. If that's okay. Seems like there may be a bit of a lag. But I do want to cover the value proposition that Catalyst has. We can get back to that. I'll speak to it. I know that we really pride ourselves on being a one-stop shop for both hard money and permanent financing loans. Real estate investors that want to get in the game, especially in the buy and hold space, really like our model because it's highly integrated, and we help smooth the transition from hard money, which allows you to purchase distressed real estate at a discounted price. We're going to talk about some of that a little bit later in the presentation today, some very exciting numbers from what we're seeing for real estate investors. And then transitioning from that hard money loan into permanent financing. We try to smooth that process, make it very integrated and easy. We're also real estate lenders built by real estate investors. So we have a pretty large portfolio in another part of our company, and we really try to take that experience, what we've learned, mistakes we've made, pass it on to you so you don't make some of the same mistakes and that you can maximize your returns. We have a single point of contact for all your loans. One credit pool, one loan officer is going to walk you through all these different processes, and we really try to put you in the product that's best for you rather than having a limited amount of products and trying to tell you why our products are good for you. That's a very big difference. We try to have the widest suite of products possible. We have 5-star customer service experience on all different platforms. Many of our referral partners, they have platforms and we rank 5 stars there, but also on Google as well as Facebook. And I'm not going to get into all the different products that we have here, but one thing that's very important as well is that we have some excellent short-term rental loan products. That's a very popular space out there today, this VRBO Airbnb part of the industry. And if you're looking for unique products designed specifically for those type of investments, we have some excellent products in that category. But I think we can just dive into the next page. And Jeff, if you'll kick it off, that'd be great.
Yep. All right, so I saw this the other day. This is from NAR. It is national data. So it says the national median sale price for existing homes is now $379, which is slightly lower than September of $385, but up 6% year over year. And the second bullet point was the one that stood out to me the most. So this is the 128th consecutive month of year over year increases, which is the longest running streak on record. So even though you may see slight dips here and there, you know, and prices are seasonal and there are certainly things that are affecting the market, but if you just kind of focus on year over year growth, we're still positive. You know, 128 months is crazy, in my opinion. That's a long time. That's 10 years worth of data. So like I said, I thought this was a really cool chart. It shows the median home prices of existing homes. I don't think it bakes into new construction, but just as an example, you look at the price. We were talking before about just, you know, investing in real estate and how it's such a strong idea and portion of somebody's portfolio. You know, if you bought a house 2018, median prices was $250. You know, 4 years later, it's roughly $380. So as you can tell over time, these numbers have gone up significantly and they're pretty consistently going up as well.
Definitely. And you know, this is national data we're covering now. One thing to keep in mind is the geographical differences are very important. We're going to dive into that a little bit too. Texas is different. Some of the Sunbelt states are very different, but to this point, I think a really good number to look at is always the year over year data, because it kind of brings in the seasonality and it smooths out some of the short-term changes. You know, we had an interest rate shock for a moment there. It definitely impacted things, but I did hear on a Housing Wire podcast earlier today that for 4 consecutive weeks, we've had an increase in mortgage applications, which is very exciting news. I think people are starting to settle in, that rates are a little bit different. The shock is starting to wear off. We're starting to see a little bit of normalization. It's not going to be as hot as it was before. That's unrealistic. But I do think we're seeing some calm seas and people are starting to get adjusted to what rates are. Steve, what are you thinking?
Yeah, so I got a couple comments if I could. You know, real estate normally goes in a 7-year cycle. It goes up, it goes sideways, it goes down. It does one. It's like the you know, the seasons, right? You have a summer, you have a spring, you have a fall, you have a winter, right? Normally, if you look at this chart, right, I think everybody on here knows that at one point, if we all bought properties 30 years ago, they would be worth more today than they were 30 years ago, right? I mean, I grew up in Los Angeles. I wish I bought properties when I was a kid, you know, 10 properties in LA, but I didn't. So I'm here talking to you guys now. Anyways, but you know, the thing is if you look at these prices, there's a steady rise. And I mean, if you look at them, there's a rise, there's a lull, there's a rise, there's a lull. When you mentioned 128 consecutive months, I personally think, as we all probably agree, you know, COVID had an effect on that, probably the last 2 or 3 years of that effect. Then injecting capital into the market, right, printing money and all that, it had to affect it somehow. What I was always taught is that properties on the East Coast and West Coast will double every 7 to 9 years, and every 12 to 15 years, they will double. Now, it's not a straight line because the property depreciates, but for this conversation, let's just say it does. And it's just a straight doubling, and we're conservative, and it's a 15-year run. So if we bought a property for $150,000 in 15 years, it would be worth $300, right? And that's kind of along the lines. And then in another 15 years, it would be worth 600 because it's going to double again. Even if we're conservative and we back that off and we say, you know what, that's BS. It's not going to be worth 600. Okay, let's go with 500. That's not unrealistic. 30 years from now, a property that was 150 is worth 500. So if you look at this number, that is pretty much in line with it. There's going to be highs, there's going to be lows. And when you guys had mentioned the interest rates, I mean, shit, I remember when I was buying stuff in 2005, 2006, if we got a 6 3/4, we were high-fiving each other. It's all perspective, right? I mean, it's all, if somebody got a 5% right now, they would be like, oh my God, how'd you find it? Where if they got 5% 6 months ago, they'd be like, wow, you're a dumbass. Like, why would you pay 5%? It's all perspective. We have such a short window of memory. And again, you know, you guys have been in this for a while. I've been doing this for 20 years. I think it's a matter of really stepping back and looking at the big picture as to what am I doing? Why am I buying this piece of property? I'm buying it to have it increase in value, use the appreciation and cash flow to make some revenue on it. This pretty much stays in line with all that. No matter what micros we have, it doesn't matter. It's still going up in value. I don't care what anyone says. Look at 2008, the crash, the world was coming to an end, and it's just a little blip on the radar right now. So this perfectly aligns with my thoughts as well on this.
Absolutely. So let's go to the next slide.
Sorry, that may have been too much. I apologize.
No, that was great.
A little.
That was great, man.
That's why you're here,
That's-
Steve.
Exactly, man. We love it. Please, we love it whenever you give your thoughts. That's what it's all about. So we're going to cover Texas median housing prices here. And if you notice, the differences are not as significant as the national numbers, right? There are some drops here. If you look at Texas as a whole, actually up slightly. Austin, which is not unexpected. We've been talking about that for 6 months. They had such a massive run up. There had to be somewhat of a correction, but it was still not that significant. You look at the year over year numbers and it's still going to be way up there in Austin, but a little bit of a correction there. Dallas still up, Houston still up, San Antonio, New Braunfels still up. I think a big part of that is Austin. And then if you're looking at the national numbers, cities like Austin and the coasts really baked in because the coast did go up more aggressively than the Sunbelt areas, which, like Steve mentioned earlier, that's kind of the pattern. They have more upside, more downside when there are corrections, whereas the Sunbelt states are normally a little bit steadier. And then you take Austin, which is kind of like a you could almost call it like a East Coast or West Coast city that happens to be in Texas because it's like a tech hub and there's so much money flowing there. It's got some of the dynamics of those coastal cities. So all of this really makes sense as well, in my opinion.
Yeah, I agree. I think, look, when the pendulum swings in one direction, it's going to swing back the other. It's just how it is, right? And so Houston is such a steady market. When you look at the number of people, I think they said like 11 people a day have been moving to Texas for the last like 4 years. 11 people. It doesn't sound like a lot on the surface, but when you start thinking about that, you're like, holy shit, that's just on the average. You know, Houston has such a diverse market, you know, and I don't know if we're going to talk about what Houston has to offer, but when I used to do presentations and talk, and I would go deep into all the things that Houston has to offer, why they were so smart after the crash of the oil bust. You know, they really got smart with diversifying. You know, you've got 2 major airlines hubbed out of here. The tax base of those airlines of what the city gets is amazing. You've got every professional sports team, including rugby, and now it's going to be the biggest cricket in North America, which I don't get that, but anyways, except hockey. They don't have hockey. So I think each one of those gets about $1 billion a year in tax base the city gets. You've got NASA, which basically owns all south of Houston with the government piece. You got the #1 medical center in the world. If it was its own city, it'd be the 16th largest city in the United States, right? You've got the #1 cancer research center. You've got, you know, you've got tech, you've got HP, you got Compact, you've got I don't know if you guys know this, but the port of Houston is the 2nd largest exporting port in the country. For every ship that comes in, 2 go out full, because they use the Panama Canal since they widened it to the Panamax Canal, because Texas is a right to work state. It's cheaper to put it on a port in Houston than it is to truck it over the Rockies to Long Beach, Seattle, or San Francisco. So for all those reasons, my whole point of this, of bringing this up, is you're not going to see a big dip because there's such stability in the city. It's not relying upon one industry, another industry. It's got so much coming here. People have no idea. And look, Austin, I get, it's a bit of a bubble. San Antonio, New Braunfels, I understand it's a big military. But when you look at those, the most stable city is probably Houston, and number 2 would be Dallas, in my opinion.
Mm-hmm.
Yeah, Dallas is very diversified as well.
Yeah,
Dallas
is Dallas is great, but Dallas is a little bit overblown. If you look at the numbers of as an investor, if you're looking at the numbers, we had an office in Dallas, and it was very hard for investors to buy something that would cash flow. So they would be negative geared, meaning it would be negative cash flow, but they were playing on the appreciation play. But at some point, that bubble crosses over, and now it doesn't even make sense because it's running out of steam and it's going to come down.
Yeah, we were talking to somebody and they were talking about it becoming a non-rental market, how all of California is really a non-rental market, and there are other cities, and Austin is kind of that way too. And if Dallas can get a little pricey in Dallas proper, that's why we've seen a lot of people do deals where they're just creeping up and up and up almost to Oklahoma basically to find cash flowing deals. Same thing in Houston. It's not as expensive here, don't get me wrong, but you can find pockets a little further out as you grow to where you can get much better deals, cash flowing and lower prices, to be honest.
Yeah, when I was doing a lot of stuff with Bigger Pockets, and I was coaching a couple people to buy their properties with Bigger Pockets and some other organizations, we would look at, there were certain metrics that I would have the investor look at, and part of that is what industry. I like to see at least 3 industries growing a city, which Houston has like 20. But there's a lot of stability numbers I want to see. And Houston always was at the top of that number. And I wasn't even, we would do all over the country for Bigger Pockets, but Houston always came in one of the top numbers because it's a growing city. The price makes sense. The rental market's good. The age bracket, it's a investor-friendly state and investor-friendly city. Or landlord rather, I should say. So there's a lot of factors that come into the reason those that you had on the last slide shows that it's not going to be a big drop, in my opinion, because there's too much lifting it up behind it.
Yep, agree. So I found this article about foreclosures because I know a little while ago I would hear noise about this giant foreclosure boom that's coming and some impending doom. So I just wanted to kind of take a look at it and see what's really happening. Now, this is national, but it's foreclosure starts. And the chart, if you look at it, it starts in 2005. So that giant run up is, 08, 09, 2010, the mortgage crisis. But as you can see, since then, it's steadily come down. And it really hasn't gotten above that 100,000 mark, since maybe 2017. It's been 5 years. And so the reason for that, in my opinion, has a lot to do with mortgage underwriting quality. During those 07, 08, 09s, literally, if you had a pulse, you can get a mortgage. You had stated income janitors making $20,000 a month. So if you look at this, obviously during the pandemic, there were pretty much no foreclosures, and it's starting to rise. But if you hear people talking about how their foreclosures are on the rise, they are. But it is all relative, and if you look at it, it's still below pre-pandemic numbers. One of the little quote down there from this Adams site that says, "Activity is reflecting other aspects of the economy. Unemployment rates continue to be really low. Mortgage illegals rates are lower than they were before COVID." So all of the fundamentals of a low foreclosure market are still there.
Yeah, another big difference another big difference in the loan quality, to Jeff's point, much higher FICOs, exponentially higher than they were before the 08 crash. But another big difference is the number of ARM loans is exponentially lower. Like, very few loans out there in the single family space are ARMs. So people aren't going to have these big adjustments that are going to impact their ability to pay. That's another huge difference. Then there were also a lot of negative amortization loans back then that actually the principal balance would go up every month rather than going down because people were so confident home prices are going to increase and outrun that. There are none of those products out there anymore. So the products and the borrowers are significantly different, and that's why we think there's not going to be this big foreclosure boom. Another exciting thing, that if you guys haven't ever read the articles, Texas Real Estate Research Center from Texas A&M puts out excellent research and data on Texas-wide real estate. It's a very interesting chart. And if you look at the national numbers on people who feel likely, very likely, or somewhat likely that they might have a foreclosure issue in the next 2 months, it's 22%. That's a little bit of a concerning number, right? 22% is not small. But you look at Texas, 8%, Dallas-Fort Worth, 14%, significantly lower. Houston, only 10% in those two categories. So those are drastically different numbers than the national numbers. And that's, like Steve was talking about earlier, whenever you're investing in real estate, you can't just look at the national numbers because you're not investing nationally. You're not buying a small share of properties all across the US. You're buying properties in specific areas. And if you're doing that, you have to look at the local economy, the local affordability index for those properties, which we'll cover a little bit later, and the economic trends in those given areas, and the migration numbers, right, which we're going to talk about a little bit later as well. How many people moving to the state? Steve talked about it earlier. Very exciting numbers for the state of Texas. We'll cover in a minute. So it's really important that you really separate these things and look at local numbers versus national numbers. Anything to add to that, Steve?
No, I agree. I mean, we've got the more focused and micro you can get, the more successful you're going to be, right? I mean, you know, when you say I play a sport, it's like, no, I play football and I'm the center snapper for long snaps. Now you're getting very micro, right? When you're an investor, what do you invest in? Why do you invest? I think a lot of people learned a lot of lessons during the last crash, like you said, lending and all that stuff. And I would be curious how many of those foreclosures back in 2008 versus now were investors, were end retail buyers, and what were their financial position? You know, if you really got into the nitty gritty of it, I think that now I will say, and again, just my opinion, I think those numbers may be softened a bit because of the moratoriums and the foreclosures and the all the forbearance and everything that was going on. People were trying to hang on. I think that, you know, there may be some, I don't want to say government interference, but there may be some government reasoning why they're not letting banks start foreclosure processes, which maybe they're just trying to stretch it out so it doesn't happen and people will get back on their feet. That could be very possible. So I think that I'm not going to say they're skewed, but I don't think that's as harsh and rough as it was in 2008. I mean, you guys remember 2008, it was like, you're gone, you're out, we're foreclosing, this is over. And they saw the onslaught that happened as a result of that. I think now the government's saying, okay, maybe that wasn't the best way to handle it. Maybe we need to help these people stick in a little bit longer. I think that my opinion of the investor world, you're going to see the hardest hit just from me being involved in, you know, organizations like Bigger Pockets and other stuff and people that I know. I think you're going to see a lot of short-term rental people hit the worst in the investor world. That's just from because they're accelerating cash flow. They're trying to accelerate that cash flow from the $1,000 a month to $4,000 a month, and they're buying it based on the $4,000 a month numbers. So I think you're going to see deals happen because it would never rent for that much, you know, and so they're going to be negative, and at some point they may go, I can't hang on to it. I think that's going to be long drawn out, but I think you're going to, that's, if you looked at a market, I think that would be the market that you're going to see the softest.
Yeah, and I think that's just based on, you know, that's a big monthly payment to cover. If you're renting a $500,000 house or a $750,000 house, your only option to cash flow is short term. Whereas conversely, if you're in a long-term price point, like a $350,000 house, you know, you can long-term, you can short-term, your payment's not that big, a lot more flexibility. And also, even if you're looking to sell that property, a more robust market in that price point than an 800 or $1 million home. It's just totally different.
Yeah, and I normally, you know, when I work with people or coach them or whatever in real estate, I normally like to see 2 exit strategies. Now I'm recommending 3. Like, you know what, you got to have 3 exits, right? That exit's blocked. You can't get off the freeway. You got to go to the next exit. So, you know, can you flip it? Meaning, can you sell it? Could you sell it subject to? Could you, you know, can you, if you can't Airbnb it, can you just, or short-term rental it? Can you rent it to midterm? I mean, there's a lot of strategies that you could do, but think of those before you buy the deal. Don't think of it once you own it and go, well, shit, how do I get out of this deal now? Which is what, you know, a lot of investors do. They think about it after the fact. So I try to get them to have at least 3 exits before they get in the game.
Yeah.
Definitely.
Little, just real quick before we move on, a little internal commercial. We have a DSCR program where you could have a property that is down to 0.65 and still qualify.
Nice.
All right, so this next one here is kind of what we were talking about with the population growth. There's a lot of slides on this, so I'll try to cover it pretty quickly. But to Steve's point, Texas grew by nearly 4 million over the last 10 years, more than any other state. So from 2020, from 10 to 20, it grew by 4 million. Nearly 1 in 4 moves into Texas from California. So followed Steve's lead. I don't know, when did you move to Texas, but
I didn't do it, man. I lived in a different California than it is today. I'll just say that. When I grew up there, it was much different. I'm going to leave it at
were you the
that.
first pilgrim and send back for people, say, hey, come on, this is pretty good over here?
I don't know.
So 24% of the moves into Texas is from California. That's a lot. And then following this inflow from Washington, Florida, Illinois, and New York, collectively representing 22 of the total inflow from out of state. So, and then look at it's kind of hard to read, but on this chart, it's got cities, it's got Houston, San Antonio, Dallas, Austin, Fort Worth, et cetera, et cetera. So to your point, it's been a massive migration from other states, primarily California, Washington, into Texas. Next slide.
Yep.
Wade, you want to cover this one?
Sure. And if you look at the states that are searching moves into Texas, it's predominantly these more expensive states, right? Higher cost of living, often high state income taxes, a lot of things that make the Texas story so compelling. Reasonable home prices outside of Austin, but still, even Austin, we'll look at a chart a little bit later on, compared to most of the coastal cities, is still very, very attractive. And then lower state income taxes and a lot of other things that just make it very attractive. So even if home prices go up, it's still more attractive than those areas. And that's a very big thing. I think we have more room to go up now and less room to go down because of the affordability and a lot of the factors that Steve talked about earlier. But it's if you look across this, the most searched areas are definitely the areas that are dominated by higher taxes, more expensive homes, et cetera.
Yeah, and I don't know if you guys cover this, but a lot of this has to do, obviously, as we know, with businesses, right? Businesses are leaving the high tax states of, the country, California and Jersey and New York and all that stuff. And when you looked at the highest ranking business states, Texas was number 10, and the number 1 through 9 was like Wyoming, Alaska, South Dakota. What was interesting, though, the only reason it was numbered 10 is because it had a franchise tax. That's the only reason. The GDP from all 9 of those other states did not even match even like 70% of what Texas does in GDP. So when you think about it, that means Texas pretty much is the number 1 state because of all the natural resources and everything else. It's close to the ocean for exporting and all that stuff. So look, when businesses say, hey, we're moving, you can either not work or you can move to a state that has no state income tax. You can homestead your home, all these other reasons. That's why they go. And so that's a big reason why all these people are migrating, because their businesses and their corporations are going there. I mean, that's one thing about Dallas. I think what do they call it? The 8 billion mile road, all those businesses on that road in Frisco area. It's because they're all going there and all the employees have to go there. So there's rapid growth. There's, explosion.
Yeah, no doubt.
So this is just a little bit more of that. So it ranks the top 3 markets of inflow. So number 1 was Fort Worth, number 2 Austin, number 3 San Antonio. So kind of what Steve was talking about earlier, typical area homes across all metro areas over this period saw an average of 57% jump in home prices, and then an additional 37% over just the last 2 years. So over that 12 years period, they went 57 and then 37. And then if you look at the map, actually, which I thought was interesting, Texas is blue by a mile, but California is also blue. So even though they're leaving, they're still growing.
No,
Yes.
hold on. This is 10-year data. So 10-year data, that's important. They're definitely not growing in the last couple of years, but 10-year data, yes.
Yeah.
Does
They
it show where the
definitely have a
migration
negative
is coming from? Like, is it coming from the South? I'm just kidding.
Doesn't say that. I'd be curious. So anyhow, like I said, it's just kind of a picture of the states that are getting all of the people, where they're coming from. And like I said, Texas was number one with the growth of 4 million people. Next slide.
So this is a discussion on interest rates. And if you think about what is the reason that there's a softening in home prices? Because the scarcity is still there. If you're looking at basic economics, supply and demand, there's a scarcity of homes. There's a scarcity of apartment complexes. We'll cover that in a little bit. There's a chart we show on how many properties have been built, and it's been the slowest decade since, even slower than the 50s, 60s, 70s, despite greater population. But it's really rates, right? Rates are really driving that. The affordability of homes is greatly impacted by rates. To Steve's point earlier, there's a lot of recency bias. The rate right now is still, we would have been doing backflips and almost every other time up until maybe 2012 on, right? So it's a very recent phenomenon that rates were that low, but that is impacting things. But we're seeing some normalization there. And the great thing about investing in real estate at this time, and we'll show this a little bit based on Catalyst business and where investors are purchasing homes as a percentage of the value of the property, which is very compelling data. But you can change your interest rate down the road. Rates are going to come back down. You can never change your acquisition price, right? Your acquisition price is going to be there. But if you can cash flow in today's environment, which you can, investors are doing it. We're breaking volume records right now. We're doing more deals than we have in the past because investors are moving in. They're getting better prices. Not necessarily the home prices are dropping, but they're paying a lower percentage of that home price. And then whenever they can refi in the future, we're going to see some outstanding cash flow numbers. Because if you can cash flow at 7%, what happens when it's 4%, right? Those numbers are going to be even more exciting.
Yeah, and the one thing I'll say is that, when you look at those numbers of the interest rates, you see the cycle, right? You see these cycles of it happening. And like you said, I remember, we were having cash flow deals. I think the highest I paid was a small bank, corporate. We did blanket loans and stuff back in 2006, 2007, and we were like 8%. And we're just like that was never a decision of whether or not we were going to buy or not buy the property. Like, it's so funny when I hear people now talking about not buying a property because of interest rate. I'm like that just, I don't know. It just, I guess it's all perspective, right? But interest rates should never drive your decision to buy or not buy a property. Maybe you should learn how to negotiate better. Maybe that's something you could focus on, right? You can't change the Fed's interest rate, but you could change the price on how you negotiate the deal. Maybe the seller can do a second. Maybe there's other, there's ways to make this work. But to cross your arms and pout and say, I'm not going to invest in my wealth because interest rates are up 2 points. Like, and I don't even know what that is, but if it was a $300,000 house, what is 1 point when it comes to your mortgage? $50? Say, is it even, does it even move the needle much? Probably not, right? If it was a $5 million house, I get it. There's some effectiveness, but when we're talking $500,000 properties, I don't see it like we're cutting off our nose to spite our face. We're so upset, we're not going to make a move. Well, here's the thing. Somebody is making a move. There are transactions happening right now. There are thousands of transactions happening in every single city. What is it that they know that you don't? Like I told you, a lot of my clients are out of country investors, out of country clients. They're like, I don't give a shit about 7%. Like we're taxed 50% on our income in Amsterdam. So yeah, no problem. So it's all our perspective, but I think that we're getting into this granular, but it's like, but what? Yeah. People were buying houses in 1983 when it was 17.5. Yeah, but people, and the thing is what I think investors need to realize, the one primal need that we all have to have, one primal need is shelter, and then the second is food, or maybe reverse. But we need to have shelter. We need to have a roof over our head. So no matter what, they are going to be renting from somebody. They are going to have a roof over their head. The question is it going to be you that's collecting the revenue? I would say if you ignore that small minuscule number that's irrelevant in my opinion, buy the deal. Buy it based on the deal of, people make a today decision on a future deal. If I asked all people on this panel, why are they investing? And they say, well, I want to have something when I retire. I want to have cash flow. So you're telling me in 20 years from now, you want to have a property that cash flows, but you're making a today decision on a future deal. That makes no sense. What is it going to be doing in, like we said earlier, with the pricing of houses? What's it going to be doing in 20 years? That property, you're going to have interest rates go down. Like we said, the property's going to go up in value, but you're going to have missed this opportunity because you were so focused on one point of interest. That to me, it just doesn't register in my mind why people would do that. I'll get off my soapbox now. Sorry.
No. It actually kind of leads into the next chart. So those are very well said. So you're talking about opportunities. This is a large part of why we are where we are with the prices of the homes. And this is a chart we look at a lot, Steve. It measures total population versus housing starts. So have we been building enough houses, right? So you see it's a pretty consistent increase on that green line, and you see a cliff around 2006 that we still have not recovered from. And we don't go back further, but the last 10 years have been the lowest number of new units built ever in a decade, if you parcel it out, I think since like the 50s. So we weren't building enough houses to support the demand of the population.
Does that include apartments as well, that number? Just
No,
houses?
I did not. This does.
I don't think so. Is that total units?
It says housing starts.
It does say total. It says I'm not sure, to be honest with you.
I'd just be curious if people are moving into apartments and not houses, or is townhomes, or I mean, I'd be curious what that number is, if that skews that at all. I don't know. I'm just
So the biggest point is that we just haven't built enough houses for the number of people, especially the number of millennials coming of house buying age. So there is just a shortage of houses to buy, and that's along with all the other factors we talked about. That's another big reason why you're seeing prices go up, even when rates go up. Even if properties become less affordable, you're still going to see prices at the levels supported by that because there's just such a demand for real estate right now.
nice. Yep.
Next slide, please. So we wanted to pull some data for this presentation, and Jeff and I had a feeling that people were getting better deals out there. And I'm not saying this is a national sample size. We do quite a few loans, but within our book of business, the average LTV that investors have paid in the last 30 days has been about 71%, median 72.5. In 2021, investors are averaging 90%. Now they were getting that great rate, right? And that made them feel warm and fuzzy. But at the end of the day, they were not getting as attractive of a deal. And if you think about, let's just take a average $200,000 home, keeping the math is easy. Paying 140-ish versus paying 180-ish, so huge difference, right? That's a huge difference. And the great news is, as we talked about earlier, you can refinance that rate on the 140 deal and eventually get the same rate you would have got when you were paying 90%. So two factors here. One, home prices do not have to drop for it to be attractive for investors. What you pay relative to price is as important as the price. And then secondarily, some people are nervous. Well, am I going to miss something? Am I going to buy in now? Maybe prices go down 4 or 5%. That is possible. Anything could happen. I can't guarantee that it's not going to happen. But trying to time the bottom is always risky. You often miss out if you try to time the bottom. And right now, you can get very attractive deals without home prices dropping because investors are paying a lower percentage of that after repairs value. So in my opinion, it's a very powerful and great time to get in because of this type of data.
I don't know, Steve, the people you work with, are you seeing similar numbers in that the cash out of pocket to buy a deal is significantly lower now than it was, say, a year or two ago?
Yeah, well, what I'm seeing is, again, real estate is math. It's all numbers, right? Any business is math. And if a variable changes, if you change a variable in the equation, the result is going to be different, right? So there are variables that have changed. The one variable is interest rates have creeped up a little bit, and you've got prices have come down. What does that equal? It kind of, on the surface, very quickly, it could equal about the same, if not a better deal. Because as you said, like, I would much rather negotiate a better price than worry about the interest rate. It's either price or terms. When I used to, buy and flip and all this stuff, I would take an owner finance deal at 10% if I didn't have to come out of pocket anything. Why? Because I'd negotiate the deal. He got the terms, I got the price. So I'm seeing this all over. When I was working a lot with bigger pockets and a lot of that stuff, you had a lot of people wanting to do that BRRRR method, which is, I don't know, some stupid acronym, but buy, rent, rehab, all this stuff. I mean, it's a good idea, but it only works in a certain window for a certain perfect time. And so everybody was so bent on trying to do this BRRRR because they wanted to fit into this certain window. And I'm like, what's the reason you're doing this? Like, really understand why. Again, you guys have these great numbers, but the bigger question I would ask these investors is, why are you buying? Are you buying this today? Are you buying this to tell your friends what your interest rate is? Or are you buying this to create generational wealth over generations? That's the bigger question, because this is all inconsequential. 30 years from now, if we had a conversation about 2008 or 2006, we'd be like, man, that's ancient history. Was that even a problem back in 2008? Well, I remember we thought the world was coming to an end in 2007 going into 08. But so I think a lot of these numbers are great. And I think it's just looking at it as a mathematical equation. The variables have changed, which means the outcome is going to change. And I think the variables are much more in our favor because the prices have come down. So if the prices didn't come down and interest rates were high, which we know is not realistic because that's not how economics works. If that was the case, then I would say, yeah, this is not a good time. But prices are coming down. That's the bigger leveraged bat than the interest rate. So to answer your question, yes, and that's just, again, this is my opinion. I could be way off, but I look at it at a long-term play, not a 3-month, 6-month, 1-year play. That I just don't look at investing that way.
Agreed. Jeff and I do have a hard stop at 1, so we are going to go through. Let's pick out some particular data that seems important on these charts, Jeff.
Sure. So for Houston, Steve, this is, you've been talking about Houston a lot. I focus on the number of sales. So the number of sales are down, but if you look at the price is still significantly up. Last year, the average price was $376. This year, it's $403. Median is about the same. And the months of inventory is 1.8 to 2.8. So, they say 6 months is a market imbalance. 2.8 is still a very healthy number. It seems like the acceleration we talked about all last year is slowing down. That's basically the number of sales relative to the number of listings. Like, you popped a house on the market last year, it was gone like that. So things were accelerating quickly. Now it's more normal where you look at that balance. The listings versus sales ratio, I guess, is 25 to 8 last year and 36 to 6 this year. So you're going to get larger days on market, 43 days versus 32 days. It's still a very healthy real estate market.
Yeah, I think this just shows that it's going back to normalcy.
Yeah.
And we should not be shocked going into November and December if there's some even greater pullback, because outside of the COVID era, seasonality was always there, right? It happens. People don't buy a ton of houses at that time of year, so we shouldn't freak out about it. I think it actually presents a really good buying time for investors.
Yeah, this next one, we found some good data on rentals in Houston. So the median rent is basically $1,800. It's got a month-over-month increase, and it's got year-over-year. So it's, in my opinion, really cool. That bottom chart down there, the median rental price last year versus this year, if you look, the dark blue line is higher than every single number on the light blue line. So rentals and the ability to charge rent has increased significantly over the last year. So to Steve's point earlier, let's say you buy a house and you're cash flowing $100, maybe $150. Just hold on a little bit. You're going to see rates go up, and that cash flow grows, going from 100 to 300 or 200 to 5. That's a massive difference in just time. To say nothing of the fact that you can refinance when rates go back down, where they eventually will, that number can grow even more.
And real quick, I'll just touch on this because, we had about 1,000 properties before we sold our company. And what people don't understand is in good times, rents are down because all your renters are leaving to buy houses. Well, when all of a sudden those people that couldn't afford the houses can't afford them, what happens to them? They don't melt in like sugar. They become renters again. So now the pool, when you had 5 renters, now you have 50. So what happens? It's price and demand. All of a sudden you can actually charge more. So in a recessionary period, if you're an investor with long-term rentals, you're actually a contrarian investor, which means that when times are down, rents actually go up. So you actually make more money as a long-term landlord in a recessionary period because all those people that own houses now are your clients again. So it's actually a great time to be a landlord.
Next slide. So in our opinion, if you haven't been on the calls before, we really believe in San Antonio and in Houston, 2 great rental markets, very attractive price points, great ROIs. And you look at the average price and median price year over year, about an 8% increase. I think Houston was slightly below that, but that's still a very good year over year number. That's slightly above probably what the average has been over time, or right at it. And I think even with some of the challenges with interest rates, you're still seeing good solid growth in overall price. But I do believe those numbers may be slightly lower than that when we go into November and December, maybe even into January. Then we're going to see I think we'll see a nice uptick going into the spring as per usual, like previous years.
Yeah, I agree.
So this one, it's got a lot of the San Antonio changed their look, so it's a little trying to adjust to it. But the one thing on here that I like, it does have the rentals. So in San Antonio, the median rental price for an existing and new home was $17.25. So you compare that to Houston, about what, $70 difference. So not a lot. You can get prices a little bit cheaper. So it's very in line with Houston, and the price is a little cheaper, the rent's a little cheaper. Still great spreads, similar growth. I think prices went up 8% year over year. So it's almost an identical market, relatively speaking. So we do a lot of deals in San Antonio. Big fans, get a lot of good deals out of there. So it's a great place to buy.
Next slide. I'm just going to point out a couple quick things here and then turn it over to Steve for a moment. But we expected a correction there. This isn't a great buy and hold area, but a lot of people were doing flips there. I'd say the flippers who got in the toughest spots may be in this area. They were continuing to expect appreciation, and it's very important that whenever you're doing flips, you don't buy at a price that you think homes will continue to grow to, that you look at that number and be a little bit cautious, especially in the upper price points, because that's where the pressure comes first as a flipper, is in the highest price points. If the market turns, that's where you're going to see it. Because to Steve's point from earlier, there aren't as many exit strategies. Your only exit strategy on those really big homes is selling it. You're not going to be able to rent it, cash flow, short-term or long-term on the really big properties. So we definitely saw that in Austin. I think there's going to be a little bit of a continued correction there. Still, year over year prices are up, but the month over month prices are down. And definitely the months of inventory, that number was like 0.4 at some point, maybe a year and a half ago, and then it's just been steadily increasing. But 6 months is a normal market, still not anywhere close to 6 months. So long ways to go there. Steve, what are you hearing about Austin?
Yeah, look, Austin is kind of in a bubble all of its own. The challenge is you got the university, people making university, they leave, they want to stay, so they work at Starbucks and other places like that. So the income doesn't match. We looked at a lot of data when we were looking at opening an office there. It just didn't make sense because the price point and the income there is so off-sided. It just doesn't make sense. So I think you're going to see a lot of bloodshed in Austin area because of the fact that it's just the income doesn't support what the price point is. And it's kind of the greater fool theory. And eventually they're going to run out of runway like flippers do, like the economy does. And whoever's left holding that one is going to be hurt. So I think you're going to see, of all the cities, I think you're going to see Austin hurt the most.
I completely agree.
Yeah, I'll just cover Dallas real quick, and then we can maybe have a minute for any kind of questions or closing thoughts. But like when talking about Dallas, I believe this is Dallas proper. The prices are up 450. Active listings are way up. Days on market. They throw in mortgage, which is kind of cool. Days on market 37 days. Like we said earlier, Dallas itself is a little pricey for cash flow, but as you migrate north and up towards Oklahoma, you see a lot of deals being done in those tertiary markets in Dallas. So still a good spot, just maybe not in the city for rentals. And then the next slide. So I don't know if you look at this, Steve, this is pretty cool, kind of right up your alley. It's the affordability index. It's a measurement of what the average mortgage payment is relative to the average income of a citizen. And so as you'd expect, Miami, LA, New York, those are in the top. Austin is the highest for Texas. They do make more money because I think of all the new tech jobs. But if you look at, say you compare that to Houston, they're making $20,000 more a year, but you're paying 200 plus more for your property. So it's a losing equation, in my opinion.
Yeah, I agree.
It's interesting. Steve was talking a little bit earlier about how, from an investor's perspective, the Austin numbers didn't make sense, household income relative to home price. But you just look a little bit higher. In Austin, the average person's making exponentially more than Miami, Los Angeles, New York, like all those cities, and their home prices are exponentially higher.
Yep.
It's really amazing. Another important thing to consider why we think there's so much upside in Texas is, we talked about it earlier, no state income tax is a really huge thing. And then overall cost of living in these other states significantly higher, like gas prices are the highest in California, significantly lower in Houston. So overall cost of living is baked in as well. One interesting thing, I went back and looked at the charts from like 18 months ago, 12 months ago. Austin was up in the mid-teens. Dallas and Houston were right at the top 20. So as interest rates have increased, these, Dallas and Houston have come down and become more affordable as these interest rates have increased. And I think that just makes a more compelling model of why we think that migration from these other higher cost areas is going to continue and going to provide real support for real estate investors across the state. Maybe not as much in Austin, even though Austin's still a more compelling value proposition than these other major cities, but definitely the Dallas, Houston, San Antonio area, especially San Antonio. Look how affordable that is. Pretty amazing relative to, you consider San Antonio is a pretty major city, a lot of attractive options, compelling reasons to move there, and super affordable.
Yep.
All right, we might have time for one question, maybe pinpoint Steve, if there's a question or two for Steve in particular, that'd be great.
Absolutely. As we wind down today, there were two main questions, one in particular for Steve. Steve mentioned exit strategies and how long does it take to get a return on my real estate investment with different exit strategies?
That's a good question. I go back to, I'm a big believer in what's the goal. You gotta go to the destination of where you're going and then work it backwards. You don't get on the freeway, start driving, and then ask yourself, where are you going, right? You know where you're going first before you get in the car, before you get in the freeway. You make sure you have gas, you make sure you have a plan, you make sure you have a map. So it's like somebody coming up to me and saying, hey, Steve, is that a good deal? I don't know if something is a good deal because I don't know your goal. I don't know what your finances are. I don't know what's a good return for you versus a good return for me. I don't know. So I'd have to know more information to understand what I could say a good return is 12 years from now. You can go, shit, I want it back in 6 months. Okay, we have different definitions of a good deal.
That's great. Well, that brings us right to our 1 o'clock stop. So with that, I'll just thank again Wade and Jeff so much for your knowledge, Steve for being our special guest. Thank everyone for attending the November real estate market update. Our December one will be right after the holidays, January 5th. And so we'll be sure and let everyone know about that. But thank you so much for attending this one today, and we will see you next time. Any final closing words, Wade, Jeff, Steve?
Appreciate it, Steve.
Yep, appreciate you, Steve.
Check out
Steve's contact information there. If you guys want to reach out to Steve, he has a lot of different things he's doing that can add value to your real estate investment goals. and just business goals in general. So if you guys have an interest, please reach out to Steve at either the number, the website, or the email address below. I think he could add real value to you. Thanks again, Steve.
Thanks, guys. Appreciate it.
All right.